Bundle versus standalone is one of the two highest stakes payment decisions you make in the founding year, and most coaches make it on a peer recommendation instead of a break-even calculation. The category fit follows your operating context, what tools you already have embedded in your marketing funnel, what your projected revenue is, and how much engineering time you can stomach. Vendor selection waits for Module 19. The category vs bundle decision is what closes today. Bundle pitch and bundle trap describe the same product from two angles. The pitch is real. One system means less friction. The four tools talk to each other because they are literally the same software, and the configuration time collapses from four separate setups into one. The trap is also real. You are tied to one vendor's pace of product development, their fee structure, and their uptime. Migrating out later means exporting client data, resetting recurring billing, and asking every paying client to reauthorize their card on file. Neither description is wrong. The decision is which one matters more for your stage and your operating shape. Bundle wins in a specific situation. You are new. You have no tools embedded in your marketing funnel yet. No Calendly link on your website. No contract tool. No invoicing platform separate from the coaching workflow. You need scheduling and contracts and invoicing and payments to work as a single client-facing flow, from the first inquiry through the first session. The monthly platform fee is smaller than the time cost of stitching four standalone tools together. And the time cost is real, usually 3 to 4 weekends of setup work you cannot bill against. For coaches starting from zero, the bundle pays for itself in the integration time it removes. Bundle loses in a different specific situation. You already have Calendly embedded in your marketing funnel, and migrating to the bundle scheduling tool means redoing landing pages and email signatures. You run a multi-coach team with workflows that diverge. One coach takes intake by phone, another by form, and the bundle assumes a single workflow. Your monthly revenue is high enough that the platform subscription plus the processing markup beats standalone plus separate tools on aggregate cost. Past roughly $8,000 a month of coaching revenue, the math usually tips towards standalone, though running your own numbers beats trusting that rule of thumb. Two risks beyond the break-even math get priced into the same decision. Lock-in is the first risk. Client contacts, payment history, contract records, and session notes all live inside the platform. Migrating means data export to CSV, recurring billing resetup in the new system, and a wave of client reauthorizations for cards on file. Not catastrophic, not free either. Vendor risk is the second. Coaching-specific platforms are smaller businesses with smaller engineering teams than Stripe, and the probability of a feature freeze, a pricing hike, or an acquisition that changes the product is meaningfully higher. Both risks are manageable when you pick platforms that export client data in standard formats from day one. Break-even math at 2 volumes shows how the answer flips. At $2,000 a month in recurring revenue, standalone runs about $89 all in. Stripe processing fees around $58, Calendly at $16, a contract tool at $15. Bundle at the same volume runs comparable once you add subscription plus markup. So at low volume, the two paths are within $20 of each other, and the time savings of one integrated system often tilt the close case toward the bundle. At $10,000 a month in recurring revenue, the platform subscription drops as a percentage of revenue, but the processing markup on every transaction adds up, and standalone usually pulls ahead. Run your own numbers on your own projected revenue. Vendor selection is a Module 19 problem on purpose. This unit names the category, bundle or standalone, and Module 19 walks the platform-by-platform comparison with current pricing, feature matrices, and integration depth. Splitting the work this way keeps the category decision clean. If you pick a vendor first and then back into the category, you end up rationalizing the vendor against requirements that were never the right ones. Pick the category here. Pick the vendor there. The decision sheet you fill out in this unit travels with you into Module 19 unchanged. Take your projected monthly revenue and run the break-even yourself. Multiply by 2.9%. That approximates your standalone processing fee. Add the current cost of your scheduling tool and your contract tool. Compare against the platform subscription plus the platform's processing markup on the same revenue figure. The lower number wins on aggregate cost, and the time savings argument tilts the close cases. If the break-even gap is under $20 a month, the answer is whichever side fits your operating context. Embedded tools push you toward standalone. From zero solo work pushes you toward bundle. The decision sheet structures both the math and the lock-in checklist into one page.